Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two top stocks to consider buying on the dip amid the quick September pullback. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two stocks, it's quickly worth noting what's going on with the market, because that's sort of the reason why we're talking about two of these stocks, since there's been a big pullback. So the market selling happened rather fast on Monday amid worries about spreading troubles from China's property market, with the S&P 500 posting its worst day since May. The S&P 500 dropped about 1.7%, and the technology-focused NASDAQ fell about 2.2%. after being down more than 3% earlier in the afternoon on Monday. The S&P 500 and the NASDAQ are now both on track for their worst months since last September, while the Dow is headed towards its biggest monthly decline since October of 2020. The worries about the broader contagion from Evergrande, which has the biggest debt burden of any publicly traded real estate management or development company in the world, is weighing on things. China is poised to let more of its businesses fail and inflict losses on shareholders and bondholders, as Beijing is increasingly focused on reining in various industries throughout their economy. That said, analysts and traders have been calling for a major U.S. index pullback after a massive 2021 run that included 50 brand new highs so far for the benchmark this year. And we should also note that that last brief sell-off in mid-July was wiped out super quickly. So this could just be the reason people are selling. Obviously, maybe we could see more impacts from what's going on in China going forward, but there was a reason there was going to be a pullback sometime soon, and this might have just been the catalyst for that. With that said, one of our technical experts over at Zacks, Jeremy Mullen, wrote last night in his commentary that, quote, the 50-day moving average is a bullish trend line that held up since the COVID lows has broken. The bears are in full control for the first time in 16 months, and a caution flag is now up. So that's where he stands at the moment. So despite the fast and big drop, the S&P 500 is down only 4% from its records, and we saw some positivity on Tuesday. Meanwhile, the tech-heavy index is also down only around 4%, and as we mentioned, both were up in early afternoon trading. Still, the market could be in for a shaky spot in the near term and throughout the rest of the fall and the winter, given the historic run off those coronavirus lows, coupled with the fact that some on Wall Street think the U.S. economy has already peaked, following a blockbuster earnings season and massive summer and spring of growth. That doesn't mean, though, that investors with long-term horizons should run and hide. In fact, they should consider doing what the best money managers do, which is buying their favorite stocks at discounts when they can, because timing the market is extremely difficult, and it can lead to that dreaded buying high and selling low. With that in mind, one widely cited technical level that often triggers broad-based buying is closer to being breached than some might assume. So both the SPDR S&P 500 index, which is that S&P 500 ETF, and the NASDAQ 100 tracking QQQ are approaching oversold territory in terms of the relative strength index, which is a figure below 30. Both are now at around 35 after hovering near overbought levels or over 70 or higher as recently as early September. So the market has tumbled really quickly, and we could see some buyers start to step in when they get to those 30 or below levels. And as we said, we already saw some people step in late afternoon on Monday, and the market was up as the last time I checked in early afternoon trading on Tuesday. On top of that, the overall earnings picture remains strong, even though some of the positive revisions for Q3 and beyond have cooled down recently. On top of that, the margin outlook for 2022 and 2023 suggests that inflation could be indeed transitory, and the Fed remains rather dovish in terms of its interest rates despite these rising prices. With all of this in mind, investors might want to consider buying some strong stocks they plan to hold for years to come, because pullbacks and corrections, which would mark a 10% drop from the recent highs, so we could still have more room to fall, are some of the best times to buy your favorite stocks. So with this in mind, we're going to take a look, as I mentioned, with two really well-known stocks that have taken a rather quick hit. And the first one we're going to take a look at is Walmart, which trades on the ticker WMT. The company posted one of its best performances in years last year, with sales up 7% in 2020, which was its fiscal year 2021, as consumers flocked to its stores and gobbled up its bolstered e-commerce and delivery options. Walmart's U.S. comparable sales surged 9% last year, with e-commerce revenue up a whopping 80%. The company has now multiple delivery and pickup options, and last year it launched its subscription service to help it further challenge Amazon. The company has also expanded its consumer base and diversified its portfolio as smaller brands thrive online. Walmart's diversification efforts include teaming up with secondhand e-commerce clothing firm ThredUp, partnering with Shopify to bring more small businesses into its third-party marketplace, and much more. Walmart's also beefed up its digital advertising businesses, and executives noted that the rapidly growing advertising platform at the company should be a multi-billion-dollar business in the very near future. On top of that, the company in early May entered an agreement with MeMD. The deal is set to help it provide access to virtual health and telehealth across the country and complement its in-person Walmart health centers. The company is also expanding its fintech capabilities. All of these efforts are helping bolster it as a one-stop shop that's setting it up to thrive for decades as big retail gobbles up all of the small players. So this is Target, Amazon, Walmart, and a few others. Walmart did start to slip late last year, and it fell further after it missed Q4 estimates and provided disappointing guidance back in February. The retailer then crushed our Q1 estimates by about 40% and then followed this up with another strong showing in Q2, where it beat both earnings and revenue. Walmart's earnings estimate positivity helps it land a Zacks rank number 2 buy at the moment, alongside an A grade for growth and a B for value in our style score system. The company is also part of an industry that sits in the top 20% of over 250 Zacks industries. And we should note that despite Delta variant concerns, August retail figures surprised Wall Street, showing that shoppers are still willing to spend money. The figure rose by 0.7%, which destroyed expectations of a loss of 0.7% and marked a dramatic turnaround from July's more than 1% plunge. So some solid showing in retail data in August supports Walmart as well. Wall Street is also rather bullish on the stock still. Walmart, with 12 of the 18 brokerage recommendations Zacks has for the stock coming in at strong buys, with 3 more buys and none below a hold. On top of that, its 1.45% dividend yield tops the S&P 500 average and the 10-year U.S. Treasury. It's also competing, we should note, against an unprecedented year of growth last year, as we mentioned at the top, yet its current year, which is FY 2022, its sales are projected to still pop 1.1% above that to about $565 billion, which we should note is an improvement from a few months back when we were calling for a little bit of stagnant growth. Its revenue is then expected to climb another 2.2% ahead of that next year. Meanwhile, its adjusted earnings are set to climb 16% this year and then another 5% higher next year. We should also note that the stock has pretty dramatically underperformed its broader market over the last year. It's up just about 3.4% compared to its larger food, drugs, retail, wholesale market, which is up 16% over the stretch. The stock is down about 5% in the past month and at around $143 a share. It's also nearly at oversold RSI levels at 36, and its underperformance really can't last much longer. Walmart could also be prepared to go further after it's fallen so quickly, because it's also trading at a 20% discount to its year-long highs at about 21.9 times forward 12 months earnings. So given its huge growth off the coronavirus lows, it's now lagged the broader retail space over the last year. It's trading 5% below where it was just a month ago, and it's now near oversold RSI levels, and it's trading at a 20% discount to its own year-long highs, and it has a really strong dividend. So if you're considering adding a strong, stable stock to your portfolio to hold for not only the next year, but maybe the next 5-10 years or longer, Walmart certainly appears to be worth considering at the moment, as big retail is hardly going to go out of style anytime soon, and it's now ready to compete even more than ever against Amazon and Target and others. So we're going to end with another stock that's in the retail space. It's operating a rather different business than Walmart, but it's another huge name that's worth considering as a longer-term play, and that is Nike. It trades under the ticker NKE, and it posted stellar Q4 results in late June that sent the stock soaring to new highs. The sportswear titan's smaller rival Lululemon then posted blowout quarterly results on September 8th that helped show the industry is thriving as people continue to dress more casually than ever. That said, Nike is set to report its first quarter fiscal 2022 financial results on September 23rd, so this Thursday after the closing bell, and it appears like it might be worth buying, though some investors likely want to stay away until after reports out of principle. But it's also worth mentioning that if you plan, like with Walmart, to hold Nike stock for the next year or longer, attempting to time it can be counterproductive. So let's go over some of the recent happenings. The strong performance to end FY 2021 was rather striking. Its Q4 sales jumped 96% against the year ago quarter and 21% compared to its pre-pandemic period. The company also swung from an adjusted loss of 51 cents per share to positive 93 cents per share to crush our Zacks adjusted earnings estimate by 82%. The impressive showing helped alleviate many of Wall Street's supply chain worries and fears that consumers would be changing their preferences on style as the economy reopened. The company's margins also climbed as its direct-to-consumer push gains momentum, with its direct sales soaring 73%. The company's relatively new CEO noted that 2021 was a pivotal year for Nike as we, quote, brought our consumer direct acceleration strategy to life across the marketplace. Fueled by our momentum, we continue to invest in innovation and our digital leadership to set the foundation for Nike's long-term growth. So like with Walmart and really every other company in retail, they're going all in on digital and direct-to-consumer. Nike's fiscal 2021 sales surged 19% to bounce back from a slightly COVID hit year in 2020. So last year's growth marked a company best in decades, and the expansion train appears to be rolling on, with Zacks estimates calling for its upcoming Q1 earnings to climb 18% on 19% higher revenue. So if we look further ahead, it's 2022. Full year revenue is projected to climb nearly 13% to $50 billion, with 2023 set to come in another 10% higher. So both of these would come on top of FY 2021's historic growth and will mark its strongest top-line expansion since 2012, outside of obviously last year's massive growth. So the company is set to post 3 straight years of huge growth. The sportswear giant also is expected to see its adjusted earnings climb 21% this year and another 17% next year. And we should note that the company, as we mentioned earlier, has consistently crushed our earnings estimates, including a 56% average beat in the trailing 4 quarters. It's also experienced some positive earnings revisions since its last report, though it does land a Zacks rank number 3 hold at the moment, given some stagnation and some recent uncertainty in terms of earnings with a few downward revisions. The company also nearly always staying on top of the broader industry. It's still a sportswear champion despite the rise of Lululemon and a resurgent Adidas in North America and the rise of upstart e-commerce focused brands that you see popping up everywhere on Instagram, or if you're watching streaming TV, that they're now having more affordable ads for some company you've never heard of. Nike remains, the champion of the global sportswear world, and this is because it has the ability to not only create trends but constantly adapt and, importantly, attach that swoosh to the biggest sports athletes and cultural icons in the world. This is from soccer to basketball and everything in between. And its ability to stay relevant and cool helps Nike continually rank as one of the most valuable brands in the world, alongside the likes of Coca-Cola, McDonald's, Apple, and many others. As we sort of alluded to already, they've invested heavily in the future through multiple shopping apps and a massive, diverse digital marketplace. Plus, the broader industry is really strong at the moment, with its shoes and retail apparel space in the top 10% of over 250 Zacks industries. The stock, as we mentioned earlier, also skyrocketed right after a strong showing last quarter, but it's tumbled recently at $155 a share. It's trading 10% below its early August records, and its rapid rise sent it to overbought territory in terms of RSI last month, and the fall has already sent it to below our oversold RSI territory on Monday, and it's bounced back a little bit as of Tuesday since it was up slightly in early afternoon trading. Nike is also currently trading right near its year-long lows at 34 times forward 12 months earnings, which is also a 30% discount to its high, and it has a dividend yield of about 0.7% at the moment. And over the last 5 years, the company has pretty easily topped its industry and the S&P 500 up 180% versus the S&P 500's 110% climb. That said, some investors might want to wait until after Nike reports its first quarter results and provide its updated guidance before they even consider buying the stock. But those with longer term horizons might want to add Nike as part of a well-diversified portfolio. And Wall Street, we should note, like with Walmart, remains really high in the stock with 15 out of the 21 brokerage recommendations that Zacks has coming at strong buys, with 3 more buys and none below a hold. So as we mentioned, Walmart, Nike, both trading at a pretty quick discount from where they were just recently amid the market pullback. There could be more near-term selling, but if you're a long-term investor, trying to time things is very difficult. And if you plan on holding the stock for a few years at least, or at least the next year, buying it now seems like a pretty solid idea. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.